Well, as the battle against the California wildfires continues, the question of rebuilding all of those lost homes and buildings will become a very important one. And part of that issue ahead involves the insurance industry. Some companies had canceled policies due to the threat of natural disaster. And there's also a greater concern about further pullouts in the state. Now, it won't happen, at least in the short term, because the state's insurance commissioner put in place a 1 year moratorium from pulling out of the state. Nonetheless, still lots of questions involving the insurance industry in the state of California. Ben Keys is a professor of real estate here at the Wharton School, and he joins me right now. Ben, great to talk to you again. How are you?
I'm doing well, Dan. Thank you so much for having me. And I want to say right at the outset, my thoughts and condolences are with everyone in Southern California dealing with the incredible challenges from these wildfires.
And obviously, the component of what's been going on in and around the insurance industry becomes very much a huge talking point, especially when you think about what could potentially be the rebuild of this area in the future.
Well, that's right. The backdrop for these wildfires is an insurance market that was already in turmoil. This is a market that has seen an enormous amount of distress over the last few years with climate change inducing ever more frequent and severe disasters, dealing with issues around inflation, rising cost of materials and labor, and then rising cost of capital, going from a low interest rate world to a not low interest rate world, has shaken up these types of insurance and reinsurance companies. And so we've seen insurers sharply increase their premiums in risky areas, and my research has been focused on that. And now the question becomes, okay, after a sizable disaster like this one, what is the path of recovery going to look like?
All right. So let me ask you that question. What is the potential path of recovery at this point?
Well, I think there are a lot of incentives that drive local policymakers to attempt to rebuild in the same location. There's a desire among local municipal governments to rebuild their tax base. And there's sort of the warm and fuzzy feelings that we get in saying that we've rebuilt bigger and better in the same location. But we know that that's not often the right strategy, and it's likely that we'll rebuild with higher quality materials and more durable materials. But I think in terms of wildfires, there's a playbook in terms of wildfire prevention. And one of the key elements of that playbook is keeping a buffer zone between that wild land urban interface. And so, I think there are going to be a lot of local pressures to want to rebuild in the exact same locations, but I think we can learn some lessons from it and rebuild in a smarter way that increases density in some of the safer locations and create some buffer zones elsewhere.
I guess it's interesting because when you think about the state of California, I guess we saw this a little bit with the wildfires in the northern part of the state the last couple of years, is that it just has been a sprawl. It's been a spread out of how builders have thought about uh, and where they have thought about putting homes in the state of California.
That's right. It's all connected. When we think about land use policies over the last few decades, those policies have encouraged building in the suburbs and in the exurbs. We've seen cities blocking increased densification. We've seen inner ring summer suburbs deciding, hey, we're all full up. We've imposed strict lot size requirements and things like that. And what that does is it pushes developers further and further away from the city centers and into the areas that are most wildfire prone. And so this is a big challenge going forward in an environment where we're going to see more frequent fires, how can we encourage development in those denser, safer locations and try to steer clear of some of the riskiest spots?
So you also, I guess, when you're thinking about policy and you think about housing policy, don't you also have to look at the types of homes that may be built or how they are constructed as you move forward? Obviously, some of the homes, especially the ones along the water, uh, are basically one level. Do from what I understand, the policy has been to build out and not up. And so maybe that changes in the mindset of how you think about building as well.
Yeah, and it's hard sort of in the immediacy of these fires to just kind of think through what some of these neighborhoods could look like going forward. But what I think part of this is again being strategic about where should we build in a way that's more dense and that allows people to return to their communities broadly defined,
Right.
and where can we avoid some of the riskiest things. But there's also another layer of wildfire prevention that I think is that sort of last mile of prevention that it is hard to do when it comes to removing all the landscaping around properties.
Yeah.
People need to give up their yard. Roads and shrubbery need to be cleared in a way that's just not very appealing to the eye. And so there is a sense in which there is something we're going to have to give up going forward if we want to really harden communities against wildfires.
So let's look at this from first the consumer's perspective, the homeowner's perspective. How then should they think about the idea of insurance, especially if they are in an area that is susceptible to these types of events?
Yeah, I think this is the tension that these markets are facing right now, which is that insurance companies are recognizing the risks. They've been very clear-eyed about climate change for a long time and the effect that that has on their balance sheet. And so that is going to lead to higher premium in risky areas. And that's what my research has borne out. Over these last few years, insurers have sharply increased the ways in which they price disaster risk. And so living in a risky area has gotten much more expensive. We should expect that it will continue to get more expensive as the path of climate change continues. And so I think this is going to be the challenge for households. It's going to be one of affordability struggles. Is it affordable to purchase insurance to live in these areas? Now, on the flip side, we should anticipate that insurance premiums will be capitalized into house prices. So ultimately, the value of the asset should decline and to sort of quote unquote compensate for those rising costs. But regardless, the position that homeowners are going to be in is one of substantially higher premium.
What needs to be done then from the regulatory side to kind of bring both the homeowner and the insurance industry to a point where both sides can feel it to be palatable?
And this is the tension for state regulators. Insurance is regulated at the state level. And so we have 50 different regulatory entities that regulate this market across this country. And they're all grappling with this issue at the moment, this tension between access and affordability. For the states where they've been more tightly regulated in the past, given insurers less discretion in setting premiums, insurers have simply left. They've said, we don't want to operate in these locations. And insurers are extremely mobile and they write annual contracts. And so they can readjust their risk profile quite quickly. But we should recognize that homeowners and policymakers are operating on a very different timescale. They're thinking about living in their house for the rest of their lives
Yeah.
potentially. So
Yeah.
there's a real tension there, and I think this is going to be where policymakers will have to collaborate with the industry and with researchers to think about both considering ways to both keep sending price signals to markets saying this is a risky place to live and a risky place to develop, but also find ways to support the lowest income homeowners in our communities who might not have that flexibility if the premiums rise.
When you have a disaster this size, and obviously we've had a couple very large ones in the last several months, when you think about the hurricanes that came through and obviously impacted portions of North Carolina, uh, what does that mean for insurance prices in general? Because these, you're talking about companies that are obviously in so many of these states that I would assume there has to be a downstream impact on insurance prices in general, as well as the region where the disaster occurred.
It's especially hard because 2025 was anticipated to be a year where insurance markets were going to normalize a bit, where we weren't going to see the sharp increases that we've seen in the last few years. And instead, these waves of disasters, hurricanes Helene and Milton, and now these awful wildfires, are driving up the costs for the insurance and reinsurance industries. And they're going to have to take that into consideration as they go forward. To your point, there's an open question as to how much of these costs are being spread more broadly across the country. So imagine a national insurer who operates across a lot of different states. They might see these losses in California. Can they pass those costs on to the rest of the country? I think it's a little bit unclear. We know that more regulated states are generally more affordable than less regulated states, but in terms of a direct mechanism across those states, it's challenging. You do have local providers in most states who potentially can undercut in terms of the pricing. So if a national insurer said, "Hey, we know that you're in Iowa, but these wildfires in California have increased our costs, so we want to drive up your premium," you could go find a local operator who doesn't have that exposure and shop around. So I think teasing out exactly that mechanism is challenging.
How does this also potentially impact the business side? I mean, so many businesses in this region as well, who had their businesses insured, obviously will feel an impact from this as well.
The business side is I think the understudied and underappreciated aspect of this. In insuring commercial property, the market is quite a bit less liquid. There are fewer players in that space, and there's been less regulatory support. There's been less effort among policymakers to make the lives of the business community easier when it comes to finding affordable insurance. Whereas, for homeowners, these state insurers of last resort have been more generous and more accessible. So I think on the business side, there's a real challenge there, and certainly we're hearing about this in the context of housing affordability because
Yeah.
this is going to drive up the cost of developing new apartment building, for instance. And we've heard stories of multifamily developers saying we couldn't get this project going because we couldn't find affordable insurance for it. And so all of these issues become interconnected in the same way. We have the climate crisis interacted with an affordability crisis.
What do you take from this unfortunate instance in terms of where we are, but where we need to go in terms of our thought process around insurance?
I think it's a great question. There's no doubt that policymakers and homeowners more generally are way behind relative to how quickly the climate is changing, how rapidly we're seeing more severe disasters, and just how seriously we need to take these changes going forward if they continue on the trajectory that's forecast. I think of insurance as being very, very clear-eyed when it comes to these risks, and we should be all taking signals from the market that they're telling us that these are riskier places to live in, and that means that we should react accordingly. That means that we should invest in being more resilient, home hardening efforts and community hardening efforts, whether that's for floods or wildfires or otherwise. It means we should rethink where we're developing. To your point earlier, where are we putting the new buildings that are going to be there for 50 or 75 years? And we should be thinking about the most vulnerable communities and thinking about ways to bring together, I would say, policymakers and the industry and researchers to shed more light on these risks and give people some sort of toolkit in order to defray some of these challenges and help them reoptimize.
Ben, great to talk to you, and thanks again for your insight. All the best.
Yeah, thanks so much for having me, Dan.
Thank you. Ben Keys, who's a professor of real estate here at the Wharton School.